Let's talk for a minute about old school trading and investing, one of those fundamental all-time principles that will help you in trading, investing, in business and in many other areas of life. And one of these key principles is called very simple and blunt: losers average losers. You know what that actually means? This actually means that if you are losing somewhere, in this case in financial markets, in some trading positions, then adding to your losing positions will make you even more loser than you are now. In other words, if you are losing money, cut your positions immediately and have a fresh start, because it has not only detrimental financial effect, but it compounds to psychological effects and losses as well. And one or two of these instances when you actually fell into loss trap could ruin your career as a trader, investor, or in that fact businessman. Now I will give you a couple of good examples. Firstly, let's have simplest equation. You are trading, for instance, I don't know, gold. You're opening long position in gold and you see that position goes south and you have some little loss. And you are seeing this little loss and you're saying, yes, I am losing like 0.5 to 1% of my capital. This is nothing much. I will wake up in the morning and I will close this position if nothing will happen tomorrow. No big deal. What happens? You're waking up in next morning and you're seeing what? Your initial 0.5 to 1% risk or losses in this case are going to 5%. And now you are feeling very uncomfortable and you are seeing and thinking, so what should I do? Should I close my losing position? Then I will fix like 5% loss, and this is starting to look at pretty good chunk of money. See where's the problem? You are now starting to thinking in positions of real actual financial loss rather than percentage loss, because now when you have lost 5%, at least 5%, instead of 0.5%, you are now thinking, yes, if I were closed yesterday and have lost some small amount of money, I would have to have 10,000 more. And now with these 10,000 euros, I would have bought something for my wife, have a good vacation or something like that. So now you are involving your psychology outside of markets, which is ruinous, and you are now thinking about real losses in real life money effects, and this is very painful. So you have very tough time to close your position because you have to fix that loss and you have to face those financial losses which you have taken, and this is really painful. So you have been thinking, maybe if you will close a bit later, you could see that this position might turn around, because nothing would be more painful to see that your small loss became large paper loss, and then when you have fixed it into wrong position, you see that this position have reversed and actually broke even and went into your profit as you initially thought it would. So you think that if you are closing now, it will be the worst place to close, and you will actually turn your potentially profitable trade as monstrous loss. So what you're thinking, maybe, just maybe, if you are buying from this losing position additional gold, this example was with gold, you might actually be at least break even, because for instance, if you are opening position at hypothetical 100, and now it has fallen to 80, you have $20 loss, for instance, in this case. And then you additionally bought it now into 80. You're thinking that if it would reverse to 100, you at least made up your losses which you made in previous trades. So now you are backing your loss with additional buy, and if positions will come even more ruinous for you, in other words, if they would continue to fall, you are thinking to buying into this losing position again. And let me tell you, actually it might go pretty well if markets are flat, and in 8 times out of 10 you might actually kinda get through with this and actually make some money in this way, because lots of strategies which are made for ranging markets actually this way makes money. But here's the thing, even if you are pulling this off and somehow miraculously trying to add to your losing positions and you are profitable, you have to have only one incorrect judgment where you will ruin your strategy. Because if we are referring to previous example, and if you are having strong belief that some crypto, gold or stock might go up, but it goes down and you are averaging up to your losing position, there might be a case when there is structural bear market, which happens once in a few years. And if this is a case, this one bad trade or investment could ruin you. And you will be surprised to see how many good actual professional traders have been ruined for this one instance. You could start with the largest hedge funds and banks in 2008 and whatnot, where they simply had one bad trade which ruined their careers. And we could go to millions and billions of retail traders or investors which thought they had good an idea, but they actually sunk in that one good idea tens of thousands of euros or dollars. And this usually happens in the cases when people are thinking, yes, I will make quick money, I will buy into, I don't know, Tesla or Nvidia or in Bitcoin or in gold because it's risen so fast, so I want to be in part of this market. But then you actually probably had bought in the worst time when bubble actually has peaked, and now you are into losing position, and now you are thinking yourself that you are a long-term investor because you simply had to wait for markets when they would average out and make back of your losses. So instead of short-term trader, you become long-term investor simply because you wouldn't accept your losing positions. So do not do this. Do not ever average to your losing positions. So if you have open position, before you actually do anything, you have to know what's the worst case scenario of that position. For a trader, it's simple. You simply risk a certain amount of your capital, and when that risk is hit, you should automatically close your position. So no questions and no discussions about it. If you are an investor, you probably are allocating a certain amount of money to specific investment. And before you do that, you have to know worst case contingency. For instance, you have invested 10 or 20% of your capital in certain venture or stock, and you might know if this stock is falling for 60 or 70%. So that means if you are allocated 10% of your capital in specific stock and this stock has lost 50% or you have 5% overall equity loss, you know that your initial idea might haven't played out that well. Believe me, even Warren Buffett, who is investing for years, have the same contingency plan, because he don't invest simply because he likes companies, and if companies are falling, he's simply buying up. No, he actually has pretty good knowledge of companies' fundamentals, and he knows companies' liquidation value. So he knows if he's buying cheap stock, company will get liquidated and he will make most of his investments back. So this is quite different from simply adding to losing position for a stock you don't have any control or fundamental understanding about it. So determine this. So if you're a trader, you have to have automatic stop loss. If you're an investor, you have to have worst case contingency plan, and if you have to see how much portfolio fall you are willing to tolerate, because there is a reason why something goes down 60 or 70%, and that's not because the company is a good one. In 9 times out of 10, it didn't work that way. But if you are investing in real-life businesses or ventures outside of financial markets, actually here the problem is more, I would say, prevalent, but it's not judged that harshly, because, for instance, if you have a business venture or some project, for instance, you want to invest in real estate, you have new startup or you have new, I don't know, any other idea, online shop, whatever, and it's not bringing you money, so you are afraid that that idea might fall, and you are starting to invest additional money, even though there is no real chance of you getting back your initial investment, plus your additional investments are not getting you any returns on equity at all. And this is how most investors fail, and this is how most small businesses fail. And here's nothing much to add from my side, apart from the fact that before anything, people have to assess certain business risks, and they simply don't have to invest because they are believing in idea. Because believing in idea is one thing, but turning this idea to real business venture, that's something else. And actually there is quite a bit of uncertainties, and I would say unquantifiable criteria which we all should take into account. And this is the reason why actually to start some business or invest in some business which requires a lot of time and capital is way riskier than you initially think. Because in real businesses, in trading or investing, we see only small fraction of winners, but we ignore all the losing projects and losses which happens in business world day and night. So my suggestion and my strong advice is as simple. In trading, it's really simple. You simply know risks before you enter trade, and you have to have small losses regardless of what you do. If you're an investor, you probably have more longer term horizon in front of you, but still you have to have worst case contingency plan when you know that your fundamental idea has failed. If you don't have this worst case contingency scenario, you don't have any business idea at all. And in real life business, actually, in fairness, this is the trickiest one to estimate because there are way more unquantifiable criteria, as I just told you. There you simply have to see and understand that you have to be able to invest certain amount of capital, and you probably have to see where and what are the criteria when this business might fail. And you have to see whether you have some angle at least. If something goes bad, you will have some liquidational value, some assets, some claims which you could collect, so you are not risking 100% of your money at the same time. So before you do anything, have worst case contingency and always know how much you are willing to put up, willing to lose, and see that there is no third or fourth scenarios where you have to simply back up your capital only to get your initial investment. Do not ever do that. That's why billions and billions of money is lost each day in business world, in any place where people want to invest and make money. So do not be one of them and calculate your risks wisely.